Imagine this. You wake up one morning. You are over 50. Your life seems fine. You have worked for years. Your family is growing. But one thought shows up. Quiet at first. Then it gets louder. If only I had started earlier. Not because your salary was too small. Not because your business failed. Not because you picked the wrong stock. For many people, the biggest regret is one money habit that looks harmless. But over time, it becomes a snowball. That habit is delaying the start. Delaying investing. Delaying building assets. Because it feels like, I can do it later. And this is where Warren Buffett's warning hits hard. Buffett never says everyone must get rich. But he repeats one simple idea again and again. Time is the most expensive asset in personal finance. In Berkshire Hathaway's annual shareholder letters, Buffett often explains the power of compounding, where growth builds on itself over time. And in many interviews in Berkshire annual meetings, he circles back to the same theme. The biggest mistake is usually not choosing the wrong investment. It is choosing the wrong habit. The habit of waiting. Now let's be honest. If you had two options. Option A, start building assets today, even small. Option B, start later, when your income feels more comfortable, when you feel more ready. Most people choose option B without realizing it. But option B is how regret begins. Because money can be earned again. But time cannot be replayed. You can't rewind time, but you can start today. This video is about the one money habit that makes people regret the most after 50. Not to scare you, but to give you a clear map so you don't repeat the same pattern. And before we go deeper, here is a quick note that matters. This video is for education and mindset. Everyone's situation is different. Income, responsibilities, and risk comfort are not the same. So use this as learning, then adjust it to your own life. If you have special circumstances, talking to a trusted financial professional can help. Alright. Now let's start with the big picture. Some people work for 20 to 30 years and still feel like, why do I have so little to show for it? Others never had a huge salary, but they look calm and stable later in life. The difference is often not the amount of money. It is the habit. A small habit repeated every month becomes your financial destiny. Buffett has often emphasized, in very simple terms, that big results usually come from small actions done consistently over a long time. I'm referencing The Snowball by Alice Schroeder, which tells Buffett's life story and highlights how strongly he believes in time and steady habits. Not one big win, but a long, boring process that works. And if you are thinking, I still have time, that is good. Because this video is here so you don't have to wait until 50 to say, why did I only realize this now? In the next section, we will tackle the main problem. Why do so many people start investing late, even smart, hard-working people? Let's talk about the real problem. Not the surface problem, but the root of it. Most people do not delay investing because they are lazy. They delay because they believe a story that sounds reasonable. The story goes like this. I'll start investing when I earn more. I'll start after my debts are gone. I'll start when life is more stable. I'll start when I understand everything. This sounds responsible. It sounds smart. But over time, it becomes dangerous. Because later is very flexible. And flexible timelines often mean no timeline at all. Warren Buffett has pointed out, in different ways, that successful investing is not about being brilliant. It is about being consistent and patient. Yet most people wait for a perfect moment that never arrives. Here is the first hard truth. There is no perfect time to start. Life does not suddenly become calm. Expenses do not magically disappear. Responsibilities usually increase, not decrease. In your 20s, you think you are too early. In your 30s, you think you are too busy. In your 40s, you think you are too late. And after 50, many people realize the cost of waiting. This is not a money problem. This is a mindset problem. people overestimate how ready they need to be. And they underestimate how powerful starting small can be. Buffett once said, in essence, that the most important investment you can make is in yourself. But right after that, he often emphasizes discipline and long-term thinking. Those two ideas only work if you start early enough for time to do its job. Here is a simple analogy. Think about planting a tree. If you plant it today, it looks small and unimpressive. If you wait 10 years, hoping for better soil or better weather, you do not get a bigger tree. You just get 10 years of lost growth. Money works the same way. The biggest growth happens quietly, at the beginning. But most people are not patient enough to let it happen. Another reason people start late is fear. Fear of losing money. Fear of making mistakes. Fear of looking foolish. So they stay in what feels safe. Saving only. Holding cash. Doing nothing. But Buffett has repeatedly warned, especially in periods of inflation, that holding cash without growth is not truly safe. In his shareholder letters, he explains that inflation quietly eats purchasing power over time. You feel safe today, but you are weaker tomorrow. Doing nothing feels safe. Until time passes. Here is another analogy. Imagine standing on an airport moving walkway. If you walk forward, you move fast. If you stand still, you still move forward slowly. But if the walkway is moving backward and you stand still, you are actually going backward. Inflation is that backward walkway. If your money is not growing, it is quietly losing strength. Another hidden reason people delay is comparison. They look at others who started earlier. They see big numbers. And they think, what's the point if I can't catch up? This thinking kills action. Buffett never focused on catching up to anyone. He focused on letting compounding work from where he was. You don't need to catch up to anyone. You only need to stop falling behind your own future. Here is a line worth remembering. You don't delay because you are irresponsible. You delay because you are waiting for certainty in a world that does not offer it. And this is where regret begins. Not from one bad decision, but from thousands of days where no decision was made at all. In the next section, we will step back and look at Warren Buffett himself. Where his thinking came from. And why his credibility on this topic is not based on theory, but on decades of lived experience. To understand why Buffett warns about delaying, we have to understand who he is. Not as a celebrity investor, but as a person shaped by habits, time, and patience. Warren Buffett bought his first stock at age 11. He has joked many times that he started too late. That joke sounds funny. But the lesson is serious. Because Buffett learned early that money has one superpower. It can grow on top of itself. And Buffett did not build his results with one lucky bet. He built them with decades of steady compounding. When people say, Buffett is a genius, Buffett usually pushes back. He often credits temperament, discipline, and time. Not IQ. Not secret information. I'm referencing the Snowball by Alice Schroeder again here, because it shows how Buffett's life is basically a long story of habits. Saving early. Tracking numbers. Thinking long-term. Avoiding flashy decisions. And letting time do most of the heavy lifting. Now, here is something most people miss. Buffett's wealth did not grow in a straight line. It grew slowly at first, then faster later. That is how compounding works. Think of it like pushing a heavy wheel. At the beginning, it feels like nothing moves. You push, and you wonder if it's even worth it. But once the wheel gains momentum, it becomes easier to keep moving. Investing is similar. Early years feel boring. Later years feel powerful. But only if you start. Buffett has explained this compounding effect in many places, but one of the most trusted sources is his yearly writing itself. In Berkshire Hathaway's annual shareholder letters, Buffett repeatedly describes how long-term compounding, combined with a sound business mindset, is what builds results over time. Not hype. Not predicting markets every week. Just patience plus discipline. There's also a famous idea linked to Buffett through his partner, Charlie Munger. The idea is simple. The big money is not in the buying and selling, but in the waiting. This line captures the core of the Buffett approach. You don't win by moving fast. You win by being steady. And if we go even deeper, Buffett often points to Benjamin Graham as a major influence. Graham wrote The Intelligent Investor, and Buffett has called it the best book on investing ever written. One key takeaway from Graham's framework is that success comes more from behavior and discipline than from excitement. So Buffett's credibility is not just he's rich. It is that his method has been tested across recessions, booms, bubbles, and crashes. His approach survives because it is built on human psychology. And the biggest human weakness in money is this. We think time is unlimited. Then life proves it isn't. Here's a sentence to hold on to. Time is not just money. Time is the multiplier of money. And that is why Buffett's warning matters to regular people. Not because you want to copy his exact strategy, but because you can copy the principle behind it. Start early. Stay consistent. Let compounding work. Next, we'll get into concept number 1. And I'll explain it with a simple United States-based analogy that makes the idea impossible to forget. Let's talk about the first core concept. The idea Warren Buffett mentions more than almost anything else. Compounding. This sounds technical. But the idea is very human and very simple. Buffett once described compounding as the eighth wonder of the world, borrowing a famous quote often attributed to Einstein. Whether or not Einstein actually said it, Buffett clearly believes in the idea behind it. You earn returns, and then those returns start earning returns. Now let me give you an American-style analogy that makes this clear. Imagine two people in the United States. Both live in the same city. Both have average incomes. Both are disciplined. The only difference is timing. Person A starts investing at age 25. Person B starts investing at age 35. Same monthly amount. Same approach. Same discipline. But person A has 10 extra years. Those 10 years are not just 10 years of contributions. They are 10 years of compounding on top of compounding. Think of compounding like a snowstorm in the Midwest. The first snowflake does nothing. The first inch looks unimpressive. But after hours, snow piles on snow. Eventually, you have a storm that shuts down the city. No single snowflake caused that. Time did. Money works the same way. Another U.S. analogy. Think about buying land in America. In many states, people who bought land 30 or 40 years ago did not predict the future perfectly. They just held it. Cities grew. Infrastructure expanded. Value increased slowly, then suddenly. They didn't win because they were smarter. They won because they gave time enough room to work. Buffett often explains this idea using businesses. A good business, held for a long time, benefits from reinvested earnings, brand trust, and scale. That is compounding in action. But here is the key lesson. Compounding is not powerful because of high returns. It is powerful because of long time. Most people think they need high income or perfect timing. Buffett thinks they need patience. Here is another analogy. Imagine filling a bathtub. If you turn on the water slightly and leave it on for hours, the tub fills up. If you wait, hoping for stronger water pressure later, the tub stays empty. Starting small beats waiting for perfect conditions. This is why delaying hurts so much. Every year you wait, you are not just losing 1 year. You are losing a year where growth could have built on previous growth. Here is a sentence worth remembering. Time doesn't just add to money. Time multiplies money. Buffett's warning is not dramatic. It is calm. But it is firm. If you wait too long to let compounding start, you will spend the rest of your life trying to catch up to time itself. In the next section, we'll make this even more concrete. We'll look at concept number 2, using very simple numbers that anyone can understand. Now let's make this real with numbers. Not complex math. Just simple, clear examples. Because Warren Buffett often says that you don't need advanced formulas to understand investing. You need common sense and the ability to think long-term. Example 1. Same effort. Different start. Imagine two people in the United States. Person A starts investing at age 25. Person B starts investing at age 40. Both invest $300 per month. That's $3,600 per year. Nothing extreme. Just consistent. Let's assume a reasonable long-term average return. Not guaranteed. Not promised. Just an illustration. Person A invests from age 25 to 60. That's 35 years. Person B invests from age 40 to 60. That's 20 years. Here is the key. Person A does not invest almost twice as much money. But because of compounding, Person A can end up with significantly more. Why? Because the early dollars worked longer. The money invested at 25 had 35 years to grow. The money invested at 40 only had 20. This is what Buffett means when he says time is the friend of the wonderful business and the enemy of the mediocre one. I'm referencing his shareholder letters again here, where he repeatedly explains that time magnifies outcomes. Same habit. Same discipline. Different starting point. And the results are not linear. They are exponential. Here is the lesson. The first dollars you invest are often the most powerful dollars you will ever invest. Example 2. Small increase. Massive difference. Now let's look at another simple case. Imagine you invest $200 per month. Then later, you increase it to $300 per month. That extra $100 does not just add $100. Over decades, it can add tens of thousands more, depending on time and consistency. This is why Buffett focuses so much on behavior. Not market timing. Not excitement. But steady action. Let me put it another way. If you save and invest only when it feels easy, you miss the hardest years. And the hardest years are usually the most important years. Here's a line to remember. Your future is built more by what you do early than by what you do intensely later. Most people think they can fix it later with bigger amounts. Sometimes that works. Often it doesn't. Because later in life, money has competition. Family. Health. Energy. Responsibilities. Early money has fewer competitors. Buffett once explained that his advantage was not doing anything extraordinary. It was starting early and staying in the game. And this brings us to a painful truth. You can't make time work harder later to fully replace the years you skipped. You can contribute more. You can be more aggressive. But you cannot recreate lost time. Here is another sentence to lock in. You don't regret starting small. You regret starting late. In the next section, we'll talk about the most common mistakes beginners make. And more importantly, how to avoid them without becoming overwhelmed. Now let's talk about mistakes. Not dramatic mistakes. But quiet, common ones. These are the habits that don't hurt immediately. They hurt slowly. Mistake 1. Waiting to feel smart enough. Many beginners think they need to understand everything before starting. Every chart. Every term. Every strategy. But Warren Buffett has said many times that investing is simple, but not easy. You don't need complexity. You need discipline. If you wait until you feel perfectly educated, you will wait forever. Learning happens by doing. Not by watching forever from the sidelines. Here's a line worth remembering. You don't need to know everything. You need to start learning with real action. Mistake 2. Chasing excitement. Another big mistake is chasing what feels exciting. Hot trends. Fast gains. Stories of quick success. Buffett avoids this completely. In fact, in his shareholder letters, he often explains that excitement is usually a warning sign. The best investments often look boring. If something feels like entertainment, it is probably not investing. Think of investing like brushing your teeth. Boring. Simple. Necessary. You don't skip it because it's not exciting. Mistake 3. Doing too much, too fast. Some beginners start and then overcorrect. They check prices every day. They change plans every month. They react emotionally. Buffett rarely does this. He believes that inactivity, when paired with good judgment, is often smarter than constant action. Here's an analogy. Imagine driving on a long highway. If you keep changing lanes without a reason, you don't get there faster. You just increase the chance of an accident. Investing is similar. Consistency beats constant movement. Mistake 4. Thinking small means useless. Many people believe that if they can't invest a large amount, it's not worth starting. This belief is extremely dangerous. Because small amounts, when combined with time, become large amounts. Buffett's early investments were small. What made them powerful was time. Here is a simple mindset shift. Small money plus long time beats big money plus short time. Mistake 5. All mindset, no action. Some people love learning about money. Books, podcasts, videos. But they never act. Knowledge without action is comfort, not progress. Buffett reads a lot, but he also acts consistently. Here's another sentence to remember. Thinking about investing does not compound. Action does. How to avoid these mistakes? The solution is not complexity. It is structure. Simple rules. Clear habits. Long-term focus. Start before you feel ready. Keep it boring. Be patient. In the next section, we'll address a very important question. What if you already feel late? What if you are in your 40s, 50s, or beyond? Let's be honest. This part is emotional for many people. Maybe you are in your late 30s. Maybe in your 40s. Maybe already past 50. And you hear all this talk about starting early, and it stings. Because you think, I missed the best years. First, let's clear something up. Feeling late does not mean you are finished. It means you are awake. And awareness is the beginning of change. Here is a line to remember. The best time to start was years ago. The second best time is today. Warren Buffett's message is not, if you didn't start early, you lose. His message is, don't waste more time. Because regret grows in silence. Action shrinks regret. Now let's talk about what changes when you start later. What's different when you start later? When you are younger, time is your main weapon. When you are older, your main weapon becomes clarity and consistency. You may have less time, but you often have more focus. You know what matters. You know what mistakes you don't want to repeat. And you are often more realistic. That matters. Because Buffett's style is not about chasing huge wins. It is about avoiding big mistakes and letting steady growth happen. In other words, even if you start later, you can still win by playing a clean game. Focus on what you can control. If you started late, there are 3 things you still control. 1. Your savings rate. 2. Your spending discipline. 3. Your consistency over the next 5, 10, 15 years. You cannot control the market. You cannot control what you missed. But you can control your next decision. Here is a U.S. analogy. Imagine you are driving from Los Angeles to New York. If you realize you took a wrong turn in Arizona, you don't stop the car and cry. You don't say, I already wasted time, so I might as well keep going the wrong way. You turn around. As soon as possible. Because the longer you wait, the more expensive the mistake becomes. Late investing is similar. The moment you realize, you adjust. The catch-up trap. One of the biggest dangers when people start late is this. They try to catch up by taking extreme risks. They want fast results. This is where people get hurt. Buffett's approach is the opposite. He would rather grow slower and survive than chase speed and crash. Here's a punchline to remember. Trying to get rich fast often makes you poor fast. If you start late, your job is not to gamble. Your job is to build a system that you can maintain. A system you can follow even when life gets stressful. A simple mindset reset. If you started late, stop thinking like this. I must recover everything I missed. Instead, think like this. I will protect my future for more lost time. That mindset shift changes your behavior. It makes you calmer. It makes you more consistent. And consistency is the only thing that still gives compounding a chance. What Buffett would likely tell you. Buffett has talked many times about focusing on what's rational and long-term. He doesn't waste energy on regret. He focuses on the next decision. And in his shareholder letters, he often reminds people that markets will fluctuate, but discipline and long-term ownership matter. So if you feel late, here's your message. You are not behind everyone. You are behind time. And the only way to deal with time is to start. Because the future does not ask when you should have started. The future only reacts to what you do now. In the next section, we'll move into the real action. Step-by-step practical moves you can start today. Not someday. Today. Now we go into the action part. No hype. No complicated jargon. Just a simple system. Because the goal is not to feel motivated. The goal is to build a habit that runs even when motivation is gone. And this is very aligned with Buffett's mindset. He focuses on behavior that can last for decades. So here is a practical plan you can start today. Step 1. Define your why in one sentence. Before you touch numbers, write one sentence. I invest because I want ___________. Examples. I invest because I want my future self to have options. I invest because I don't want to depend on my children. I invest because I want peace, not pressure. Your why is your anchor. When markets move, when life gets busy, your why keeps you consistent. Here's a line to remember. A plan without a why becomes a plan you will quit. Step 2. Build a simple safety base first. This is not exciting, but it matters. Before aggressive investing, build a basic safety cushion. A small emergency fund so you don't panic sell when life happens. Even Buffett, with all his investing skill, keeps strong liquidity inside his company. Berkshire Hathaway is known for holding large cash reserves for flexibility. The point is not to hold cash forever. The point is to avoid being forced into bad decisions. Your version can be simpler. Start with a realistic emergency buffer that fits your life. Not perfection. Just protection. Step 3. Choose one simple long-term vehicle. Remember, no stock recommendations here. We focus on principles. Buffett's principle is to avoid complexity and favor long-term ownership. In many public settings, he has spoken positively about broad, low-cost index funds for most people, especially those who don't want to analyze businesses deeply. The key idea is not the name of a product. The key idea is diversification and low cost. Ask yourself, can I stick with this for 10 years? If not, it is probably too complicated. Here's a punchline. If you can't hold it calmly, you shouldn't buy it excitedly. Step 4. Automate the habit. This is the most powerful practical step. Automation removes emotion. Automation beats motivation. Set an automatic transfer the day after you get paid. Even if it's small. $50. $100. $200. Start where you are. Because the amount is not the most important part. The habit is. Here's another punchline. The best investment plan is the one that happens even when you're busy. Step 5. Use a simple rule for increasing contributions. Most people never increase investing because they don't plan for it. Use a simple rule. Every time your income increases, increase your investing by a portion. For example, if you get a raise, you keep some for lifestyle, but you automatically raise your monthly investing too. Not because you want to be extreme, but because this keeps lifestyle inflation from stealing your future. Here is a clear mindset sentence. Your lifestyle should grow, but your future should grow faster. Step 6. Check your plan on a schedule, not daily. Beginners often check too often. Buffett does not live like that. He thinks in years, not days. So pick a schedule. Monthly check for contribution consistency. Quarterly or yearly review for bigger adjustments. Not hourly. Not daily. Because daily checking creates emotional noise. Here's an analogy. If you keep digging up a seed every day to see if it's growing, it won't grow. Your investments are the seed. Time is the soil. Consistency is the water. Step 7. Protect yourself from the biggest risk. Quitting. Most people don't fail because they chose something terrible. They fail because they stop. They stop when the market is down. They stop when they feel tired. They stop when they think it's not working. But compounding needs continuity. So build a rule for yourself. I will keep contributing even when it feels boring. I will not panic when prices move. I will play the long game. This is not just finance. This is character. Here's a punchline to keep. Boring done consistently beats exciting done randomly. Step 8. Make it real. Your 30-minute action today. Let's make this practical. Today, set a timer for 30 minutes and do this. Write your one-sentence why. Calculate how much you can invest monthly, even small. Set up an automatic transfer. Choose a simple schedule to review. That's it. Not a perfect plan. A real plan. And real plans beat perfect plans that never start. Here's one more sentence to lock it in. The market rewards patience, but life rewards action. In the next and final section, we'll wrap everything up. A strong closing. A clear summary. And a simple call to action you can do right after this video ends. Now we go into the action part. No hype. No complicated jargon. Just a simple system. Because the goal is not to feel motivated. The goal is to build a habit that runs even when motivation is gone. And this is very aligned with Buffett's mindset. He focuses on behavior that can last for decades. So here is a practical plan you can start today. Step 1. Define your why in one sentence. Before you touch numbers, write one sentence. I invest because I want ___________. Examples. I invest because I want my future self to have options. I invest because I don't want to depend on my children. I invest because I want peace, not pressure. Your why is your anchor. When markets move, when life gets busy, your why keeps you consistent. Here's a line to remember. A plan without a why becomes a plan you will quit. Step 2. Build a simple safety base first. This is not exciting, but it matters. Before aggressive investing, build a basic safety cushion. A small emergency fund so you don't panic sell when life happens. Even Buffett, with all his investing skill, keeps strong liquidity inside his company. Berkshire Hathaway is known for holding large cash reserves for flexibility. The point is not to hold cash forever. The point is to avoid being forced into bad decisions. Your version can be simpler. Start with a realistic emergency buffer that fits your life. Not perfection. Just protection. Step 3. Choose one simple long-term vehicle. Remember, no stock recommendations here. We focus on principles. Buffett's principle is to avoid complexity and favor long-term ownership. In many public settings, he has spoken positively about broad, low-cost index funds for most people, especially those who don't want to analyze businesses deeply. The key idea is not the name of a product. The key idea is diversification and low cost. Ask yourself, can I stick with this for 10 years? If not, it is probably too complicated. Here's a punchline. If you can't hold it calmly, you shouldn't buy it excitedly. Step 4. Automate the habit. This is the most powerful practical step. Automation removes emotion. Automation beats motivation. Set an automatic transfer the day after you get paid. Even if it's small. $50. $100. $200. Start where you are. Because the amount is not the most important part. The habit is. Here's another punchline. The best investment plan is the one that happens even when you're busy. Step 5. Use a simple rule for increasing contributions. Most people never increase investing because they don't plan for it. Use a simple rule. Every time your income increases, increase your investing by a portion. For example, if you get a raise, you keep some for lifestyle, but you automatically raise your monthly investing too. Not because you want to be extreme, but because this keeps lifestyle inflation from stealing your future. Here is a clear mindset sentence. Your lifestyle should grow, but your future should grow faster. Step 6. Check your plan on a schedule, not daily. Beginners often check too often. Buffett does not live like that. He thinks in years, not days. So pick a schedule. Monthly check for contribution consistency. Quarterly or yearly review for bigger adjustments. Not hourly. Not daily. Because daily checking creates emotional noise. Here's an analogy. If you keep digging up a seed every day to see if it's growing, it won't grow. Your investments are the seed. Time is the soil. Consistency is the water. Step 7. Protect yourself from the biggest risk. Quitting. Most people don't fail because they chose something terrible. They fail because they stop. They stop when the market is down. They stop when they feel tired. They stop when they think it's not working. But compounding needs continuity. So build a rule for yourself. I will keep contributing even when it feels boring. I will not panic when prices move. I will play the long game. This is not just finance. This is character. Here's a punchline to keep. Boring done consistently beats exciting done randomly. Step 8. Make it real. Your 30-minute action today. Let's make this practical. Today, set a timer for 30 minutes and do this. Write your one-sentence why. Calculate how much you can invest monthly, even small. Set up an automatic transfer. Choose a simple schedule to review. That's it. Not a perfect plan. A real plan. And real plans beat perfect plans that never start. Here's one more sentence to lock it in. The market rewards patience, but life rewards action. In the next and final section, we'll wrap everything up. A strong closing. A clear summary. And a simple call to action you can do right after this video ends. Let's bring everything together. Warren Buffett's warning is not loud. It is calm. But it is serious. Most people do not regret losing money in the market. They regret never letting time work for them. They regret the habit of waiting. Waiting to feel ready. Waiting for more income. Waiting for certainty. And one day, they realize something painful. The cost was not money. The cost was time. Let's quickly recap what matters most. First, the biggest enemy is not lack of knowledge. It is delay. Second, compounding only works when you give it time. Small, boring actions done early beat intense effort done late. Third, Warren Buffett's credibility comes from decades of consistency, not shortcuts. As shown in Berkshire Hathaway's annual shareholder letters and in the Snowball by Alice Schroeder, his results came from patience, discipline, and long-term thinking. Fourth, if you feel late, you are not disqualified. But you must stop wasting time trying to catch up and start building a system you can sustain. Fifth, action beats intention. Always. Here are a few lines worth remembering as you move forward. You don't lose because you start small. You lose because you start late. Time doesn't wait for motivation. Time only responds to action. The future does not reward regret. It rewards consistency. Now, one last gentle reminder before we end. Everything discussed here is for learning in perspective. It's not a promise, and it's not a shortcut. Real life has ups and downs, and results take time. Use these ideas as a guide, then adjust them to your own situation and comfort level. When in doubt, learning from trusted sources or professionals is always a wise step. And now, here's your call to action. Not tomorrow. Not next month. Today. After this video ends, take 30 minutes. Write your why. Set up one small automatic step. And let time finally start working on your side. Because years from now, your future self will not ask how perfect your first step was. Your future self will ask only one question. Did you start? If this video helped you think differently, share it with someone you care about. Someone who still believes they have plenty of time. And remember, you can't rewind the past, but you can still design the future. Thank you for listening.